This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In this video, I'll be going over the data sets and technical analysis for the SPY for January 14th, 2026. And with that said, let's go ahead and jump straight into the data. Now, on Tuesday, January 13th, we had the very crucial CPI data, the Consumer Price Index. Now, we talked about this in the last two videos, how potentially I was seeing that extremely likely I was expecting the CPI coming in slightly weaker. Um, but we still have the non-core CPI holding its strength from the last reading. So the core CPI, very slight decrease. It does matter, but it is a very slight decrease. And then the standard CPI technically was neutral. So overall, it is treated as a neutral print, even though we are seeing some cooling within the core CPI. Um, Going with the labor market as well, we're continuing to see weakness within the ADP numbers. Again, this needs to be closer to about 40 to 50,000 for each week. We also saw the 30-year bond auction today. It was not a great auction. The yield came in slightly higher, and this was after the fact of seeing the CPI data, and just hearing some of the overall just hawkishness from some of the state heads and everything else. So moving into tomorrow's PPI data, because again, January 14th, we have the PPI data at 8:30 a.m., followed by some existing home sales at 10 a.m. And then we have the Atlanta Fed GDP at 12 p.m., followed by some Fed speakers, Bostic and Kashkari. Mainly want to focus on Kashkari's speech because usually Kashkari is willing to kind of dig a little deeper into monetary policy and what their stances are moving forward. And we also have the very crucial beige book at 2 p.m. Now, seeing how we had I don't want to say fully neutral, but it was a mostly neutral CPI, we should be really anticipating somewhat of the following from, the PPI, because the PPI and CPI generally stay together. So if we have a cooler CPI reading, generally we're going to be seeing a cooler PPI. That doesn't always happen, but generally that's how it works. So my expectation for the PPI tomorrow, based on the CPI today, would have been we will very likely see a slightly cooler but neutral PPI overall, and that's kind of the expectation we moved into this whole CPI and PPI week with. That really we expected a neutral print, but me personally, I was expecting cooling just because of all the data we've been seeing. Now, for me, the PPI data doesn't matter so much tomorrow because whether this comes in hotter or cooler, it doesn't really matter because for me, it matters mainly about the consumer. So we got the consumer point of view. If producers are going to start raising their prices or anything, then obviously that will influence next CPI reading. But yeah, I'm not really expecting anything to come out tomorrow and have a super hot PPI or something. So yeah, I'll stop rambling about that. But for me, the main thing tomorrow is the beige book. Again, just very quickly going over what the beige book entails. It covers all the Fed central banking districts, and they will go out to all the local businesses, and they ask, how's the consumer doing? How are sales doing? How are the employees doing? How's business doing? Blah, so that they can get an extremely boots on the ground approach to gathering some of this data where it's not just being passed through, other data agencies. They're actually hearing from the businesses themselves. So For me, out of anything coming tomorrow, the beige book's the most important because it will be telling us the true economic picture, and it doesn't tell us based on the previous readings. It's based on the current. So, um, compared to some of these previous data sets where we're still looking at November, December, still some October readings, the beige book will be extremely current. It'll be for January. So, um, yeah, I like current data. Um, moving into Thursday, January 15th. Let's see what we got. I believe it was mainly Tuesday and Wednesday this week that were the big days. So we do have some manufacturing data on Wednesday, or I mean on Thursday, excuse me, and the export and imports. Okay, all right. So mainly tomorrow again, CPI and beige book. I am anticipating the CPI or the PPI to be neutral. So, um, expect a little coolness just from, my own personal opinion, but overall I do expect the PPI to be cooler. I do expect that to pull the market upward in terms of equities. I do expect it to help pull down the treasury yields slightly after today's elevation.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
Getting into the technical analysis as always, let's ensure our daily time frame is turned on and let's take a very quick look at the moving averages and Bollinger Bands. Now, moving into Tuesday's session, I was expecting that upward push into the upper Bollinger. Um, just very, very quickly, and I will go back to the moving averages and everything. But we've been identifying a ton of bullish structure. And I will delete these channels on the day because those don't matter right now. And again, we are seeing this bullish structure continually present. Now, it's hard to say why is that continually present, but I'm going to show you right in here. And I actually might pull this down to the hourly time frame just to show this a little bit better. However, in this first cup right here, and this is the cup we're going to be looking at because that's the extension of this larger structure. Now, again, this nested cup right here is based off of this larger cup. So you have the cup, you have the handle, and then you have the nested handle. Okay. So going over that, we have our cup, we have the handle. From this handle, it's once again creating an additional nested cup. Okay. And generally, we see that done for liquidity's sake. If there's not enough liquidity, or there's the dealers are trying to grab additional contracts or anything, that additional level, then they will continue to build cups because that's a very good structure to do that. It pulls up, pulls down, shakes out a lot of the calls or the upward position. They're able to pick that up and profit greatly. Rinse and repeat, rinse and repeat. We've been seeing that happening for literally months now, months and months and months. Um, However, we have broken this extremely strong consolidation range, and I haven't marked that out. Um, but technically, the top of this consolidation range is right here. We're going to make this a white line so it's very, very visible. Now, let me delete this so that it is a little easier to see. Now, what does this mean? We have this consolidation channel that has taken us actually months to break out of. I mean, this has been months and months and months and months and months of work. So, what does that mean? That extremely likely hitting this level again is purely to build support. And why do I say that? We hit this level today with, some pretty decent selling. And the reason why I say it's decent selling because we actually saw the VPIX pull up towards the 100 range, getting above that 98, which is that extreme cautionary selling range. We did see that occur, um, which is that's how we got the low of the day. And this looks very, very deceiving right here, but I am going to start to show this that we're having a inverse head and shoulders building potentially from the bottom of this, um, the selling that we saw on Tuesday's session. And why does this support matter? Because technically, this is creating an additional handle upward. Okay, off of this previously created very large cup and handle or very large cup. So that's bullish liquidity. This so far looks like bullish liquidity. Are we seeing any bearish structure in here so far? Personally, I'm not. The only thing I am looking at here so far is an extremely micro selling channel. Um, Other than that, that is the only bearish thing I am seeing in terms of the structure. We don't have a head and shoulders taking this downward. We did have one during the day, but that already played out. Um, the only thing that I'm seeing potentially is could we be forming some sort of inverse cup and handle to pull downward? Okay. I personally don't think so. This doesn't look like that type of structure. This looks like a lot of bullish choppiness to pull back upward. And let's see the ADL today. And I'm going to turn off the drawings. Even the ADL today, even though it was a, quote unquote selling day, the ADL was flat rather than pulling downward. So for me, that's a good signal. That's showing that money wasn't really leaving the symbol as much as we might have thought it was. And going back to, generally how I start these videos, with the technical analysis of the moving averages and Bollinger Bands, is that for me, this looked like an upper Bollinger rejection. However, we did dig into the hourly time frame that showed that potentially there is a very, very bullish structure going on here. If that bullish structure plays out, and I'll discuss why that I think that's going to occur in just a second here, is that right now we had a 5 mod test from the previous 5 mod test, which I believe was last Thursday. Just want to make sure the date was correct. Yes, last Thursday, the 8th, we had a 5 mod test. And from that 5 mod test, we've been seeing a lot of buying. Now, generally, again, every 5 mod test is about 5 trading sessions. Um, that's how we get the 5-day moving average. Now, that doesn't always mean that it's going to be every 5 days. Sometimes we can have the 5 mod tested, um, say, for example, once on Monday, once on Wednesday, and then we may not see it for a whole nother week. Um, some of these moving averages, again, move a lot faster. So with the 5 mod currently being where the market is right now, and the market almost closed exactly on the 5 mile. With the market closing at 693.77, it looks very, very deceptive, but technically the 5 mile is still going to be pulling up tomorrow on open. Um, the current level is 692.42. On your screen, it's going to be showing 693 with the market again closing at that 693.77. It is above the previous 692.42. That does mean that the 5 mile will be pulling upwards. So even though today was a quote unquote bearish day, it actually wasn't. The moving averages are still telling us that the 5 mile is still pulling upward. So there is bullishness to be had. If we see buying from this 5 mile range, you know, after the PPI data, after, some of the data sets tomorrow, if we have data go in the favor of the bulls, that pulls yields downward, pulls the dollar downward, then a bounce off of this 5 mile into the upper Bollinger looks extremely strong. Now, the bearish thesis would be that I've talked about these ranges where we're above the 5 mile, but below the upper Bollinger, and how if it doesn't push into the upper Bollinger, generally those ranges like to um, basically reject off the upper Bollinger and create a pretty large sell down. I'm not anticipating that, but the fact that we have been in this upper Bollinger range now, potentially for almost 7 full sessions, because there's the 1, 2, 3, 4, 5, 6, 7. Okay. Um, Potentially that's 7 rejections of the upper Bollinger. So are we in this very weird range of we're rejecting the upper Bollinger and all of a sudden we're going to drop very hard? That's potential, that's something that's potentially going to occur. So I want to make that present, but again, that's not what I'm expecting to occur based off of what we've been seeing with the treasuries and everything today, based off of the VVIX, which again, the VVIX is elevated right now. It closed at the 101. However, going over the actual just price action of the day, we did see it pull downward quite a bit before pulling back up towards the close. And with this pulling up to that 102, which is that, quote unquote selling range, we were only at the 5 mile on the SPY. So if we see this pulling upward from the 5 mile test, then that's going to be a very, very, major indicative of that, or a major indicator that we're going to be continuing the sell off. If we see this pulling downward, which again, this can move 20 something dollars within the session. Okay, this is a very active tool. This isn't like the VIX where it might pull up 30 cents on the day to quote unquote show bearishness. It's either going to be pushing upward to show active selling, or it's going to be pushing downward to show active buying. Um, there's really not an in between, and that in between itself is a signal because it's showing the chop. Again, this is kind of how we measure the VVIX. If you're above this 98 range, that means that very, very likely we're seeing selling on the SPY, which that's what we did see today. If you're in the yellow range, very likely seeing consolidation. And if you're in the green range, very, very likely you're going to be seeing buying on the SPY. Now, we are within this red range, but just to kind of preface this a little bit, these red ranges don't last very long. They like to have these very large pops upward, and then we pull back down. Pop upward, pull back down. Pop upward, pull back down. So, not that I'm, excuse me, not that I'm, suggesting that this is going to be one of those large pop upward and pull down, but that is what we anticipate from the VIX, or the VVIX. So if we reject this upper Bollinger again, if we reject the 5 mile on the SPY, that's going to be telling us a very clear signal that extremely likely we're going to be seeing selling all the way to the 20 mile on the SPY. And again, the 20 mile level right now is at that 680, excuse me, I can't talk, 685.76. So we do have, a whole $6, $7 down if we're going to be seeing that downside, and potentially even further if we test the lower bounds of it. However, again, we have been testing the 20 mile quite often. Generally, we should be seeing it tested once every 20 trading sessions. However, we've been seeing a lot of the 20 mile over the last 3-4 months now. So does that mean that we need to see the level again? By all technicals, we don't. We could be continuing to push upward for probably another 2 months straight before needing to see that 20 mile. Um, just based off of how many times we've been seeing it previously. So, in the grand scheme, this structure looks extremely bullish. It can be deceiving, but it does look bullish. We are above the 20 mile. We do have the moving averages in a bullish, um, you know, setting, because we have the 5 mile above the 10 mile, 10 mile above the 20 mile, 20 mile above the 50. so on and so forth. We haven't actually had an upper Bollinger push since October 27th of 2025, which generally that's actually fairly rare. I generally am anticipating these upper Bollinger pushes about once every month and a half. So we're starting to get to that point where, okay, we haven't pushed the upper Bollinger in quite a while now. This is creating a major support zone that is creating a lot of buying to continue pushing us back to, that 700 plus range that I've been discussing. And we've had a lot of opportunities in this structure to do that. Um, However, we're finally seeing the real end of the structure because if this structure doesn't push upward, it's going to start pulling downward pretty hard. Okay, so that's really what we're looking for here is that our supports, all the moving averages, look very good. Even though we did have some selling today, it didn't really sell us toward a level that we need to be super, super concerned about. It's not like we sold off below the 20 MA or anything else today. We have technically just sold off to the 5 MA. Going over the actual 5 MA itself, technically today could have been just a 5 MA test and bounce. Um, Again, if we see large buying from the open, this is extremely likely going to bounce into the upper Bollinger. With the upper Bollinger at the 699, basically 700 range, that is unlocking that 701 through 703-ish, or that upper Bollinger day one type push. So if we're going to be having a very large buying day, you're going to be seeing the buying all the way up to that 700, 702-ish range. It won't be just very, very slow buying. It'll be something that will be extremely large to the upside. Again, this has been a very, very, very large consolidation range that has been built over many, many months now. Almost a whole 5 months of this being built now, 4 months of this being built now. Um, you build structures so that they can move the market. If we're seeing a lot of bullish structure building here on the daily time frame, and we're continuing to see the market uptrending, then extremely likely we're going to see this liquidity taken as bullish liquidity to push us into the leg upward. So that's going to be tonight's video. Um, there was something that I want to cover really quick. This last bit of the video, I wanted to cover something with the options, but I don't have it set up on my Weeble on the PC we're right now, so I'm going to have to just kind of discuss this rather than show a physical, um, something that you can physically see and look at. But I will discuss this in another video when I actually do get the Weeble set up on my computer and everything. But with that said, we have our delta, and our delta is the Greek that determines how much money we are making per dollar upward or downward on the contract. So, for example, if we have a delta of plus zero point 0.7, okay, that's telling us that for every dollar upward in that contract, in the trading price, that that contract will be seeing roughly $70 of growth based on the dollar upside movement or not. Now, a large portion of the delta is created from the gamma. The gamma is, and in the most simplest way I can say this is the expectation of where investors and traders are wanting the price to go. So if I'm wanting to drive a gamma level, for example, say the SPY is at let's just say 700, and I am some massive, massive, massive hedge fund, and I say, okay, I want to push to that 705 range. So I go, I load up a bunch of contracts at that 705, but obviously the price is still a whole $5 off. So I'm not going to be getting my returns based off of a high delta, okay, because of it's out of the money. Um, so
how am I selling that contract? How am I buying that contract? I'm buying it off of largely the other Greeks. Okay, and I'm not going to be going over all the other Greeks in this video. It's not for that, but primarily the IV and the gamma are going to be driving those initial prices. The delta has not set in those type of contracts yet. And because the delta has not set in those contracts yet, the movement upward or downward isn't going to catch the full delta price. For example, if the market was at 700 and there was a ton of buying pressure to the upside, and we were seeing a lot of IV going into the calls, it would push the gamma upward and it would push the delta upward. Sometimes you can have large gamma moves without the delta being pushed. So that's sort of what happened with a lot of the calls that were sold, not on the Tuesday session, not so much on the Monday session, but it was really that Friday session that everybody's talking about. Um, that's how that works, and I wish I could show you a little better example of that, but again, I don't have it prepared right this moment, but that is how that happens. Sometimes you can have skews within the Greeks where, for example, um, say we're going to have Powell speaking soon, and everybody's anticipating he's going to be coming off dovish, pushing the market upward. So there might be a ton of upward gamma expecting that upward push. There might be a ton of upward delta expecting that upward push. However, there might not be a ton of gamma and a ton of delta expecting a rejection from that range. So even though the delta on puts, if selling started to occur, would climb very, very quickly because people would be loading into the puts, that would drive the IV up, that would drive the delta up, all that good stuff. But it would take the crowd and the large majority of investors to swap over to that contract to drive the IV up, to drive the gamma up, and then to start driving that delta price up. So there's a lot that goes behind these Greeks, but sometimes these moves can be sold off when the contracts are really telling you that the move isn't there. That's why tracking the Greeks can be an extremely useful tool, and that's why it is something I generally do track, but it is hard when I don't have my office and everything set up. When I do have the office set up, that is something that very likely we're going to be having on the screen at all times so that we can, discuss any sort of movements we do see, where if we see a large gamma push to the upside, how can we profit off of that, even if the delta isn't there yet? So options can be very, very difficult at times. There's again a lot to go over in options, but that's why you can see some of those, I want to say, wonky moves within the options, because it's like, okay, well, the price is moving upward, we're all in calls. How come the delta isn't being pushed upward? How come we're not seeing the movement in these contracts? Well, because that's really because we're not seeing the gamma in those contracts right now. We're seeing the gamma within the downside of the opposite end. And because of that, it's not allowing that delta to be pushed upward. So, okay, that's enough rambling about the Greeks. I hope you all have found this video enjoyable, and hopefully you learned something from it. With that said, I will talk to you all in tomorrow's video. Thank you all for watching my content, for supporting me, and everything else. I love being able to do what I do and, um, share my experience and everything with you. So thank you for your support and everything, and I will talk to you in tomorrow's video. Let's make tomorrow a very, very great and successful trading day, everybody. Take care.